Hi, it's Nero here from Investment Rise, and in this video I want to look at whether negative gearing really is the best way to achieve wealth through property. See, because let's first look at what's negative gearing. And negative gearing essentially is that you hold an investment property and the holding costs, which are your interest payments, your rates, your insurance, your maintenance, all those costs that come along with holding an investment property, those costs are greater than the monthly rental income that you get. Okay, and then over the year you make a loss on from a cash flow perspective on that investment property, and then you get to claim a portion of that loss as a tax deduction. I think it's very, very important because I see a lot of people when it comes to negative gearing say, well, it doesn't matter if my property is say $5,000 negative per year because I'll get that back in tax. No, you don't get the entire $5,000 back. You only get a portion of it depending on your tax rate. So I think that's the first thing to really be clear on, is that you don't get it all back. Second of all, when it comes to investing in property, you should never, 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 never invest just for tax benefits. You see, I see too many people who are on good incomes and they'll go to their accountant and their accountant will say, you're paying too much tax. You need to bring your tax down and you should buy a negatively geared property. And so since that's the advice they get, they go and buy a negatively geared property. But here's the problem with that. If you buy a negatively geared property, you're simply buying it just for the tax benefits. And what if the property doesn't rise in value? Well, then what have you done? You've just simply gone and given a lot of your hard-earned money to this property that isn't rising in value. You may as well use the money to go and have a holiday with it. So one of the things I always say is when it comes to investing in property, be clear on your goals. If it's about wealth creation, if it's about building a portfolio that can then fund you in retirement, you need to ensure that each property you buy is a stepping stone to the next one. Right? And if you continually focus on negatively geared properties, well, eventually you're going to hit a wall when it comes to your personal cash flow. There'll be a fairly large negative impact on your budget, obviously, as you can probably understand. But number two, and this is the thing most people fail to realize, is that you're going to hit a wall from a perspective of borrowing capacity. What do I mean by that? Well, there are so many people I know who bought one investment property in, say, Sydney or Melbourne during their last boom, which was about 2012 to 2017. And yet, when they got that capital growth, they got that equity uplift, they then went back to the bank to say, look, we want to use this equity to then buy another property because that's the aim of investing in property. But they were surprised to see that more often than not, the banks turned them down. And I said, we don't understand. We've got equity in our properties. But here's the thing. If you're buying properties that are negatively cash flowed, that means from the bank perspective, it means that you have less net income every month. Which means then now you are a bigger risk, I guess, from a bank perspective. And so if based on their calculators, they don't think you can afford another property because you already have one or two investment properties that are negatively cash flowed, guess what? It's curtains, you're done. You can't borrow any more money, which means you can't buy any more property. And so you've really got to be clear on what you're trying to achieve. If you're just trying to buy one property, hold it for the next 25 years, maybe even pay it off and then see what happens, it's fine. You can buy a negatively geared property as long as the cash flow meets your requirements. It's not going to stress you too much, all good. But if you're trying to build a portfolio, you've got to ask yourself, well, what is it that you want? Yes, you want long-term capital growth, and during that time when you wait for that capital growth, because you are never going to be able to time the market absolutely perfectly and buy a property in an area just before it rises in value. Okay, nobody can. So there are going to be periods of time when you buy property, and you're going to have to wait for it to rise in value. And during that period of time, what do you think is better? Do you think it's better to have a property and then have to pay some of your hard-earned money each and every month until it starts rising in value? I mean, many people, for example, will say, look, Sydney and Melbourne, negatively geared property, but during 2012, 2017, prices rose significantly. People made lots of money. Yes, that was only a 5-year period though. Go back a bit further in history. Go back to what happened in Sydney and Melbourne between about 2003 to 2012. What happened? Those markets were essentially flat. Maybe some pockets had a little bit of growth, but generally speaking, they were flat. And there were so many people I know who bought property and held on to it for as long as they could, but every month they had to keep forking out money. And they only got a portion of it back in their tax benefit. Some of them couldn't hold the property long enough and had to sell before the boom happened. All right, so if you're looking to hold property for the longer term, you've got to ask yourself, can you afford the negative cash flow? Now, of course, there are some properties, if you do your due diligence well enough and if you buy in pockets where the demand is greater than supply, what you might find over the coming few years is that negatively geared property does turn positive while it also rises in value. That's the ideal. But anyone who tells you that always happens is just either naive or lying to you, because it doesn't. All right. So when it comes to negatively geared, you've got to ask yourself, am I happy to go negative and have this property impact on my lifestyle for a certain amount of time, hoping I'm going to get capital growth? Or would you prefer instead to be paid while you wait for capital growth? Because that's what buying property for positive cash flow is. It means that every month you get income from the property while you wait for capital growth. Now, of course, there are people who say, yeah, but Niro, don't you have to choose? Don't you have to go, either I want capital growth but negative cash flow, or I'll go for positive cash flow, but I've got to give up on capital growth? Not necessarily. There are many locations right now where you can get both. You can get growth right now. Prices are selling right now for higher than they were, say, six months ago. And you can get positive cash flow. Now, when I say positive cash flow, let me be clear. I'm not saying that one property is necessarily going to give you, $2,000 a month and you can buy 2 or 3 of them and then you're going to try and retire. That's not what we're talking about. What I am saying is you could find a property that pays you maybe $100 a month or $200 a month. In other words, it doesn't impact on your bottom line, doesn't impact on your cash flow. It pays you a little bit, which you can use that extra money to maybe pay down your mortgage or whatnot, but you're not being taxed from a cash flow perspective, which means then you can start building that portfolio. And when you do your due diligence and you find properties that are rising in value that are also giving you a slightly positive cash flow, especially with the current low interest rates that we have, well, then you can keep buying some more whenever you're ready. And you can build that portfolio and you can use that first property when it rises in value as a stepping stone to then go to the next one and the next one. And that's the difference between buying property that's negatively geared purely for tax purposes versus buying property that can give you a return versus buying property that can give you a good long-term capital growth and that you're buying it as part of an overall plan to achieve your financial goals. If you take nothing away from this video, I just want you to take away 2 things. Number 1, never buy property just for tax benefits. Number 2, focus on your goals, be clear on what it is you want to achieve, and then go about finding the right property for you. Hi, it's Niro here, and thanks so much for watching. If you found this video valuable and you're thinking you might like my help to help you find property that's under market value, that has good capital growth potential and positive cash flow, then click the link below this video and you'll be taken to a free class where I explain exactly how we do that. And then if you like what you see, you can book in for a strategy call with me personally. Either way, thanks for watching.